Recipes for technical trading success in Cook's Kitchen.
Welcome to your 2015 correction roadmap, and my theme is 2011 Redux. All right, I got some notes here for you. Take a look. I'm going to draw 4 comparisons between the correction of 2011 and the correction we're experiencing now. You can pause this slide later and look at the details. I may just refer to it for my notes. First of all, what was the market doing before the correction? Well, in 2011, from February to August, it was going sideways and making sort of a rounding, rolling top. You know, bears were getting foaming at the chops, and bulls were getting nervous. That's exactly what we had here in 2015 for the first half of the year, first 7 months, going sideways, right? Second thing they had in common, there were some global jitters, out of Europe back in 2011. Here, some worries about China and recession chatter. We had some weak economic data. Earnings season was so enough recession chatter that made you think this is not going to push the market lower. What we need is a catalyst. Well, we finally got one in 2015. It was the Chinese yuan devaluation. In 2011, you may remember, it was the debt ceiling debacle. All right, so those were the first 2 similarities, going sideways, in need of a catalyst, and then so we finally get the catalyst. So 2 more similarities between 2011 and 2015. The third one was we get a big violent drop. Okay, I'm going to show you a chart in a minute of 2011 and August. On August 4th or 5th, the S&P dropped 60 points in one day, from 1260 to 1200, 5% drop in one day. Huge, scary volatility there. Well, we just had a couple of big drops here with indexes moving down 10% in 2 days. So there's your big drop. The fourth similarity is now we're going to have big violent swings, and you'll see we're already having them this week. Today is Wednesday, and yesterday on August 25th, you saw the S&P, big 2% up move in the morning, and then a 3% down move in the last hour. Just in the last hour, the S&P lost 3%. So we had those same kind of violent swings back in 2011. All right, let's go to that chart. Here we go, 2011. I wrote 2 months of VIX between 30 and 50. We'll talk about the VIX in a minute, but it's about this volatility. So the blue lines I have here on the bottom is S&P 1120, and on the top is S&P 1220. Here was the big down day. I believe I can't remember if this is August 4th or 5th. Right here that I'm highlighting, that was 60 points down. The day before, I wrote an article, look out below, because I said, hey, once we lost 1250 on the S&P, this thing was going to go south, and then the debt ceiling debacle was the catalyst. Okay, now look at some of these moves. I got a black dot on here, which gives the prices for August 23rd in 2011. Just as an example, look at the high-low range. The high, where the market closed, because it was a big rally day, was 1162. That came from a low near the previous day close of 1122. So nearly a 40-point rally in one day, and you can see other big down red candles. So this is that's a lot of violence in the market. Now 40 points on S&P 1150, that's a 3.5% move in one day. And this is why, and we got a lot of those in that 2 month span, August through September, until the final bottom in October of 2011. That's why the VIX stays up here. A very simple way to use the VIX that I always teach people is, since volatility is proportional to the square root of time, for you math majors out there, what you do with a VIX number is you simply divide it by 16 to convert it into a daily volatility. So for instance, if the VIX is at 32, you divide it by 16, that means a VIX, remember the VIX is always calculating annualized standard deviation. So You divide by 16, which is the square root of the number of trading days in the year, roughly 250, 256 trading days in the year. The square root is 16. So you divide whatever the VIX is, let's say it's 32, by 16, you get 2. 2% daily moves? Sure, we're seeing a lot of 2% daily moves. That's why the VIX can be at 50, because the VIX is pricing in 3% daily moves. And we're seeing those. 50 divided by 16, roughly over 3. We are going to see some more 3% moves, is my theory, because I think the bottoming process for 2015 is going to look a lot like this chart from 2011. And so why did the market bottom here? Why did it take its time, 2 months doing this? Because there were serious recession fears. We had political dysfunction in Washington and brinkmanship with the debt ceiling and two parties going against each other. And that took a while to work that out. There were also worries about Greece, again, in Europe. So, you had to work this bottom out. We may come back to this chart. I think I want to move on and talk about some of the drivers. Well, actually, let's talk about the big fat difference between 2015 now and 2011. The story is valuations. Hey, we have recession fears now, but they're not as high now as they were then, but the valuations are higher. Let's do the comparison here. So I say that in 2011, S&P 12-month forward EPS was at $100. That means at S&P 1200, you're trading at 12 times. That's why I called S&P 1100 to 1200 an extreme value area, trading at 12 times forward. And I said, hey, if there's no recession, you want to be buying here with both hands. So while the market hung out there, you got a chance to collect some of your favorite stocks and even trade leveraged ETFs if you wanted to. The point being, it was safe to buy as long as there was no recession. So while some forecasters and strategists and economists might have said, hey, there's a 50% chance of recession, if you thought they were wrong and there was too much fear built into the market and you thought, hey, I think there's only a 20% chance of recession, then you were a better buyer of stocks. All right, so what's our situation now? Well, in 2015, we have S&P 12-month forward EPS at 120 plus. Full year 2015 estimates are around 120. If we move in the next year, estimates are obviously going to be higher. You could talk about something as high as $125 for the next 12 months. And that puts you at sub 15 times at S&P 1900, which is where we are now, S&P 1900. Okay, so say it's 16 times if estimates might be vulnerable in the future. 16 times? Yeah, it's not the bargain it was back in 2011 at 12 times. Where would we have to go to make this market a very compelling bargain, assuming there's no recession? I assert that a solid valuation reset would be S&P 1750, where the market would be trading at 14.5 times 120. So you could say even 1800 is still cheap, under 15 times, as long as the EPS is above 120. So that's the math you can play with there, but we're basically talking about this market needing to correct lower on valuation concerns and recession fears. So the big question is does China's turmoil increase chances of global turmoil and chances of recession here in the U.S.? You know that in the spring I moved to a 20% chance of recession in the U.S. based on the economic data. Now, maybe I'm at 22% or something like that, but nothing really dramatically has changed in the economy. It's just the stuff going on over there. But that can have an impact. It can definitely have a psychological impact. We just had strong consumer confidence. Not that consumers even understand how China's turmoil could affect our economy, but I think the data we see going forward from here in the PMI and ISM surveys, any institutional surveys of sentiment and outlook on the economy, GDP forecasts, interest rate forecasts, all the data we get for the next 2 months, and including sentiment and forecast data, is going to be very important because it's going to tell you what is the mood among large investors about the probability for recession, and that will impact if they're buyers of stocks here or not. All right, let's move on here. What's next? Okay, so here's my correction roadmap. We are trying to hang on to S&P 1900 here, but I don't think the worst is over. I think a real test of this October low of 1820, is at least a coin flips bet. And we go down to 1750. Boy, I'd be buying this thing with both hands as long as my recession probability doesn't climb above 25%. So this is the 1750 to 1820 zone where I say buy recession fear here. And a note about the lows. So Monday and Tuesday this week, the low in the S&P, sort of a double bottom at 1867. But the futures overnight, each night, were much lower. Coming in, Sunday night, Monday morning, the S&P futures went down to 1820 on that, sort of mini flash crash, all kinds of electronic problems with market making and brokers. And then last night, so Tuesday night, Wednesday morning, the S&P goes down to 1850, and bounces hard, opens above 1900. So this has happened before, where the S&P futures do a lot of the heavy lifting overnight. The fear gets wrung out, and you get a chance to see. You get a chance to see fear in action, then you get a chance to see who comes in and buys those S&P futures. Because if somebody's in there buying them, when they can't buy their favorite stocks at 3 a.m., but they're buying the S&P futures, hey, that's a way for them to put cash to work and gain some alpha, so to speak, and get a better position in the market. But I still think the cash market has to go down and test those levels. I think it probably will. We've got an unfilled gap up at 1970 on the S&P. We could definitely rally up to there in the next few days and then probably head back lower. All right, so always taking a step back here and looking at the longer term chart. I mean, this is only a 3-year chart, a daily chart, but it gives you some good perspective. It'll take a while, I think, to get back up through S&P 2000. So that's why I think we can spend 2 months creating a range. That's my, this is my capitulation indicator. We'll go back and look at the S&P range in a minute. Let's do this first. This is my last chart. This is my favorite capitulation indicator, the S&P 1500 high-low percent. And I've got 2011 on here so you can see what happened. The whole point is that this takes time. Look at how this cratered down below 25% 3 times in the span of roughly, 2.5 months. So we've been down to minus 27%. That's where this came in on Monday. It came in at minus 27%. Tuesday it bounces back up to minus 8%. I think we have to go back down. Just like markets and price levels want to test the lows, there are more sellers, meaning people who've been long stocks at S&P 2100 or S&P 2000, who probably want to let go of them if their recession probability has climbed. So let's just flip back to our 2011 roadmap. Now, there's no way that 2015 is going to look exactly like 2011. It's just a rough guide to how these things work out, especially when you've had a big correction and there are legitimate recession fears, and then you're having these big ranges. There's no way that with the VIX up above 30 that this market launches back up to S&P 2000. So use the 2011 analog as a rough guide to how a bottoming process might work out, and how new data and recession fears are absorbed. We've got the recession fear. We're waiting for new information about China. What's the impact of, has there been any impact on the U.S. economy and sentiment in the industrial surveys? And then obviously the other elephant in the room is the Fed on September 16th, the 2-day meeting. They come out with their forecasts. They're feeling the pressure to raise rates. Is that going to be a nail in the coffin here? Well, it's hardly a coffin, but a nail in the correction, and give us that push down below 1800. All right, lots of stuff to think about. email me, follow me on StockTwits and Twitter at Kevin B. Cook, and let's see how this roadmap plays out. Till we talk to you next week.